My name is Carolina Nofal. I work for Title Partners of Florida.
Oh, excellent. Carolina, I'm so glad you talked to us. Okay, you have as much time as you need to talk about all the wonderful, amazing products and services you offer our members. The floor is yours. If you need to share the screen or anything else, just let me know.
Okay, definitely. Let me see if the president and attorney is here. Richard Adams. Richard, are you here? If he's not here, we'll talk. Richard Adams, are you here? He's the president, attorney of the company, of Title Partners. I know he was trying to get in the Zoom. Okay, well, Title Partners of Florida is a title company attorneys own and operate with more than 20 years in the industry. We are escrow agent, title search. Hello?
It's okay. I'm turning her off right now. I got to mute somebody.
Can you hear me?
Yes, we can.
Okay. So we have more than 20 years in the industry doing title. We are attorneys own and operate. So with that said, we have the unique ability to clear difficult and complex title defects. Our attorneys have an experience of 50 years in the industry. We know that for all of you, it's very important to do the closing and for your customers to be happy. So, we try to be always available. We have, our processors and closers have a great experience. And you also have me that I do the marketing, and Richard, that is the attorney, that we are always available. So, when you send us the contract, we start working immediately in the contract. We do the title, the lien search, title commitment, so you don't have to wait on that. And then you have, the office and Richard, that is the attorney, and myself, that you find us all the time. We give you our cell phones and you can reach us, and we oversee all the function. I mean,
hi, Carolina.
Yes. Oh, there is Richard. Richard is the attorney of the company. Richard.
Good morning, agents. It's a pleasure to be able to sponsor this class called tax savings, right? Taxes and savings. So we are a full service title and escrow company. We are attorney owned and operated. We pride ourselves on reliable service and good communication. We're able to do mobile closings all throughout the country. And when it's outside the country, we're able to do RON closings, as it's called, which is a form of electronic closing where we can verify the person's identity here locally instead of having to rely on a notary in that country. We're also set up with a type of software to process our files, to process our title files by the name of Qualia, which allows the realtor to go into the file using a password and so forth that they create. Allows the realtor to go into the file and obtain status and check any information or documentation that they want to. Example, the HUD, the CD, the title search, the lien search, or what have you. But I think where we differentiate ourselves the most from other title companies is that our attorneys, including myself, are very much involved in the title company. So we do not practice other areas of law and then just kind of leave the title company to be run by the paralegals. We are actively involved in the title company. Lydia Casada, who's a 20-year attorney, actually helps manage, run the title company and also process files. And I also run and manage the title company. And I act as a liaison between the title company and the realtors, and basically spend most of my day helping the agents, helping the realtors with their transactions, whatever they may need, language for an addendum, a problem or obstacle that came up in the transaction, whatever it might be, I get involved and I try to help the agent. So that's where we kind of differentiate ourselves from other title companies. We are very accessible. We are attorneys, and we set up a system where I myself in particular am available pretty much 24/7, I'd hate to say, to help you guys out. We went ahead, I think Carolina went ahead and posted our direct email addresses as well as our cell numbers in the chat. Okay, so you'll be able to access it there. Just in case, my direct email is radamslaw@bellsouth.net. That's radamslaw@bellsouth.net. And my cell number or direct number is 786-290-1963. So anyways, enjoy the class, have a great day, and reach out to us if you need us. We'd love to work with you. Thank you.
Thank you so much. That was fantastic. And guys, 24/7 support. That's not every title company does that. So regardless of the time, if you're looking for a new title company, these guys have done wonderful for us, and they've been a trusted sponsor with us too, and we greatly appreciate it. So you're showing something. Please talk more.
Oh, I'm sorry. I didn't mean to interrupt you, but this is our company, Title Partners of Florida. I'm sorry, but I'm on my way to our West Palm office today, so I'm sitting in a cafe here. So anyways, that's us, Title Partners of Florida. That's our logo there and so forth. Okay, so thank you so much for the warm introduction, and let her rip.
Excellent. Well, hey, I didn't know you were at a cafe. I thought that was just your background at the house or out in nature.
Some kind of juice bar. It's pretty cool.
Good. Well, we appreciate you coming in. Thank you so much for your time. And his contact information is in the chat, and we will also send you his email and everything else after this class is done when we send the video playback. Okay, Chris, Don, the floor is yours. We have a packed house again today. I think we found a brand new class that we'll be doing at the end of every year to prepare people for the future. Hold on, I'll have to mute that person. So Don, Chris, whenever you're ready, the floor is yours. Thank you so much for hosting this class today.
All right, my pleasure. My name is Don Fallenbaum, a CPA, also known as a real estate CPA. And for those of you who were at the Hard Rock last night for the association's holiday party, what a great event that was. I might have met some of you last night. If I did, good seeing you again here today. And I tell you one thing, Miami realtors definitely know how to party. That's for sure. So with that said, the focus of my talk today is really important subject. It's on having the right business structure for your business. And that's really becomes the foundation for everything else that you're going to be doing from a tax standpoint, is having that right structure set up initially, or when you do it. As realtors, you may not realize it, but you basically are business owners. When you became a realtor, your service obviously is being a realtor, but as a business owner, you also have the other side of being in business, and that is taxes and our silent partner, Uncle Sam, that we all need to deal with. And you can either deal with it by planning effectively and taking advantage of the tax laws, or you could deal with it without planning and just kind of doing it ad hoc and paying whatever you pay and pay more than you need to. So the idea is to focus on your business, and at the same time having the right advisors and the right structures on the other side, so that everything is done according to compliance. You don't need to deal with any love letters from any kind of jurisdictions, the IRS or the state of Florida. And you can just go about and really focusing on what you do best, and that's real estate. So with that said, I'm going to start off with, okay, so you become a realtor, and everything is going great. And by default, I'm going to start off with the easiest structure, and then I'm going to kind of branch off into different options for you, so you know what the differences are and what the pros and cons for each one is. So by default, you start off, you're a realtor. You're basically an independent contractor, and you're going to receive a 1099 at the end of the year in your name and in your social security number. As such, you're considered, without doing a thing, just kind of going the way that is, you're considered a sole proprietor, and you're going to be filing what's called a Schedule C on your personal tax return, which in effect is a business schedule where you're going to report your total income, you're going to report all your various expense items, and then the net profit then rolls over to the rest of your 1040, your tax return, and becomes part of your income. So I started off with the sole proprietorship because by default, you don't have to do anything. That's what you are without doing a thing. And that's, I guess, one of the benefits of it is that you don't have to do anything. You know, you just simple, you don't have to file any papers, you don't have to get involved with anything else. You just automatically, by default, you're a sole proprietorship. Now, what are some of the downfalls with that? Number one, like I said, everything is reported on a Schedule C, which becomes part of your personal tax return. And as such, everything is the IRS will see all your various line items for your various expenses, for your deductions related to your real estate business. Now, if you keep impeccable records and great backup, it's great. If you do get audited, you know, it's going to be a hassle and it's going to be stressful, and you probably have to pay someone to represent you, but chances are nothing will be changed. You won't have to pay an additional tax. However, I don't know how many people keep impeccable records and have the backup for everything. So with that said, the Schedule C, because everything is reported on your personal return, it gives you more of a likelihood or more of a chance of being audited by the IRS. Okay. The other factor with Schedule C is, from a tax standpoint, the net profit on the Schedule C, that's after all your various deductions or expenses, is also subject, besides your tax rate at whatever your ordinary tax bracket is, depending on what your income is, it's also subject to what's called self-employment tax at 15.3%. And depending on your income level, that could be quite substantial. You know, I've seen a lot of clients and a lot of tax returns that, you know, it's a big part of what their tax burden is a self-employment tax. And what is self-employment tax? Self-employment tax basically, well, not basically, but is payroll tax. That's what it is. Where the 15.3% comes from is, if you're an employee, a W-2 employee, you get withholding from your paycheck, which is Social Security, Medicare. That equals 7.65%. The employer then matches the other 7.65%, and together that totals 15.3. So as a sole proprietor, self-employed, being self-employed, you're basically responsible for both sides of it. That's where the 15.3% comes from. Now, there's other business structures that you could help alleviate that. Okay, so that's a sole proprietorship. The second thing is, I'm sure you've all heard LLCs. Everyone runs the SunBiz and sets up an LLC. So what is an LLC? An LLC is a hybrid between a partnership and a corporation. Now, the problem with an LLC, and I'm also going to cover some pitfalls and some mistakes that I see all the time that can easily be avoided by just doing it properly, you know, initially. And this class is going to give you a lot of information that helps you avoid the potential issues and potential problems down the road, and save you a lot of headaches, and save you money in taxes as well. So an LLC is a hybrid. By default, a single member LLC, which most of you would be, because you're basically, you're a realtor and you're forming the entity just yourself. You don't have partners for the most part. So a single member LLC, from an IRS standpoint, is classified as what's called a disregarded entity, which means it basically doesn't exist in the eyes of the IRS as a separate taxable entity. So you run to SunBiz, you file for an LLC. You're thinking, wow, now I'm saving money, I can have all these deductions. And come at the end of the year, you go to your tax advisor, your tax preparer, and say, okay, I have an LLC now, I'm going to save all this money. No, okay, because an LLC did absolutely nothing for you. You're still going to file a Schedule C on the personal return. Nothing changed whatsoever. Okay, now if you have a partner, then it becomes a multi-member LLC, and in a partnership or in an LLC, the partners are called members, and a partnership they're called partners. In a corporation, they're called shareholders. So in a multi-member LLC, then it's reported outside your personal return on a partnership return, and you get a K1 for your share of whatever the profit or the or the losses, which becomes part of your personal tax return. So with that gives you a little bit of audit protection, because then everything's reported on the separate tax return, and the only item that flows into your personal is that net number on what's called a Form K1 that comes from the partnership. But for the most cases, most realtors are not going to be a multi-member LLC. You're not going to have partners. It's going to be yourself, and it's going to be a single member LLC. And again, it's not going to help you at all. Okay, you still have to go through the filing, pay for the filing costs and the whole bit, but there's no help there. So the next entity, and I'm sure you've all heard of, are PAs. Okay, so what is a PA? A PA stands for professional association, but what a PA is, in essence, is a corporation. That's what a PA is. You're forming a corporation. So you run again to Sunbiz, you go online, you set up your PA, and now you're incorporated. Okay, great. And again, you do the whole year, you set up your PA, you're thinking, oh, now I'm going to save all this money from what I'm hearing from everybody. I have a PA now, it looks good on my business card. And okay, you go to your tax advisor and, okay, I have a PA now, save me money. No, again, okay. By default, a PA, okay, is or a corporation is a C Corp. As a C Corp, when you pull money out of the company, you have what's called double taxation. Okay, so what you want to be is you want to be an S Corp, not a C Corp. And there's certain paperwork you have to elect to be an S Corp. You're just not automatically an S Corp when you go on Sunbiz and file for your PA, for your corporation. So as such, then you take money out of the business, and now you're looking at double taxation. Now, again, it's filed on a separate tax return, but it's not good from a tax standpoint. If you did the right thing and you formed the S Corp, you filed the right paperwork, it's called the Form 2553, and you did that, that's great. Now you're an S Corp, you can take advantages of it. However, there's still another step, okay? Once you have the entity set up, you have to go to the DBPR, and you have to change your name with the DBPR. Once you do that step, then you have to go to your broker, and then you have to tell the broker, okay, now I have a PA set up. This is the new tax ID number for the PA. And going forward, I want all my closings to go through the PA and not through my social security number. Now you're good. Okay, now everything is going to be reported through the PA. Everything from a audit standpoint, everything, all your line items, all your expenses are on a separate tax return. Again, the only item that becomes part of your personal return is that net number that flows through on the form K1. It's the same form as a partnership, on an LLC partnership, but now you're on S Corp. Now, if you do have a partnership set up, it's going to help you again from the audit risk standpoint, but the flow through from that K1 is still subject to that self-employment tax. So even though it helps you a little bit on the audit standpoint, it's not going to help you from a tax standpoint, okay? The S Corp, on the other hand, will. That flow through from the K1 that comes from the S Corp now is not subject to self-employment tax. So if you had, let's say, $100,000 in net profit on a Schedule C, you're going to pay an extra 15.3% of self-employment tax, about $15,000. You have that same $100,000 now. That's you set up a PA as an S Corp. Now you file your what's called an 1120S, which is a corporate tax return. Everything is reported there. the net number, the 100,000 now you receive on a K1, that gets put on your personal return. However, now that 100,000 is not going to be subject to that 15.3%. Okay, and that's $15,000. So that's where the big savings is from the S corp. Now, there's always a catch with everything, right? So the catch with the S corp is that when you have an S corporation, someone needs to be providing services to that entity to produce the revenues. Okay, and that someone is you. Again, you're the only owner of that entity. So you are the one producing the revenues. You need to pay yourself what's called reasonable compensation for those services. There's different ways of computing that. It's very subjective, okay? But as a simplified guide sort of rule of thumb is you want to keep it somewhere between 40 to 50% payroll salary versus distributions from the S corp. Now, what are distributions? Because I said that the net profit is not taxed to the corporation, but flows through to the individual's tax return on the Form K1, you're taxed on the net profit regardless of the money you take out. You can leave all the funds in the business account, not touch it. You're still taxed on that net profit. Okay, but obviously you're in business to make money. You need the money to live on. So you're going to be pulling money out during the year. So that those funds that you take out during the year, I often hear clients or people say, okay, I paid myself payroll of 50,000 or 75,000, but no, that's not payroll. Okay, you drew money out. Basically, what you're doing is you're taking out an advance against a profit you're going to pay tax on at the end of the year. Those are called distributions. It's not payroll. Okay, payroll is when you have taxes taken out, when there's payroll reporting that these are done on a quarterly basis, and you actually file a W-2, W-3 for yourself at the end of the year. Okay, that's payroll. So from the IRS standpoint, this is a big hot button with the IRS, is that if you have this S corp now set up and you have 100,000 in net profit and you take all that money out, and I'm talking net after all your expenses, so you have available cash flow to pull out of the business of 100,000 after paying all your expenses, and you just take transfers, you transfer it into your business, into your personal account, or you write yourself a check personally, or however you do it. That is called a distribution. The IRS doesn't like that. Okay, doesn't like that at all. And that's a big hot button with the IRS, and there's a good chance you will get audited. So by having the partial amount of accommodation, excuse me. I'm sorry, I had to turn my Bluetooth off on my phone because my earpieces are actually connected to my phone and my computer at the same time. So I get an incoming call, I cancel it out. So, okay, so I just did that. So what I was saying is that the IRS doesn't like all distributions. So what you need to do is you split it between payroll and then distributions. And what you're basically doing now is instead of paying that 15% payroll tax or the self-employment tax on the full 100,000, now you're only paying it on roughly 40 to 50,000 of payroll. So you're cutting it in half. So you just saved yourself about $7,000 in tax by doing that. And again, the higher your income, I use that on a $100,000 example, but the higher your income level, the more savings you're going to have, from having the S corp, and it could be quite substantial. Okay, so that's the S corp. Now I already touched on a couple of problem areas. One is setting up a single member LLC, thinking you're going to save money, and in fact you don't. It doesn't do anything for you. You set up a PA, but you don't do the S election. Okay, so that doesn't do you a lot of good. And the other thing I see a lot is you go ahead and you set up the PA, you set up the S corp, and everything is done properly there. You may have used a service to set it up for you, and everything is good. However, you don't do the other steps where you contact the DBPR, and then you contact your broker and have your closings now go to your new tax ID number instead of your social security number. So you set up this PA, everything is done right, except you don't contact your broker and don't do those last steps, which are no big deal. But if they're not done, it becomes a big deal because you don't take advantage of what you just did. And now you still get a 1099 at the end of the year in your name and your social security number, and you're kind of back to square one. Okay, so those are some very important things. The other thing that I see a lot is the name of the entity, the name of the corporation. Okay, it's got to be exactly the way your license is with the DBPR. If there's a middle initial, you've got to have the middle initial on there. If it's your full name spelled out, if your abbreviated name, it's got to be exactly the way it's listed on your license certificate with the DBPR, comma PA or comma LLC. Okay, and if you don't do that, again, it'll get kicked back, and that becomes a real hassle, because then you're going to have to do a name change with the state, with SunBiz, and then once the name change is done, part of the process is getting what's called a tax ID number, an EIN number with the IRS, but that's tied to the other name. So then you have to contact the IRS and then change it there. And then you have to go back to your broker and DBPR. So it becomes a big hassle. And that could easily be avoided by doing it right the first time. So if you could just take that one takeaway, from this class today is having the right name set up, that'll potentially avoid a lot of headaches, for a lot of you. And a lot of headaches comes back to me because I'm the one normally has to fix it. So I'm trying to alleviate headaches for myself as well. So that's that. Let's see. That's basically it with the entities. Now you might ask yourself, so when does it make sense to set up a PA, to set up an entity? I just started off. I have maybe a few small closings. I have a lot of expenses, which basically I may even have a loss. Okay, so does it make sense to go through the process and spend the money to set it up? And then there's extra filing, there's extra accounting costs, associated with it. When does it make sense to do it? Generally, the break even from a dollar and cents standpoint, I see it generally in about the mid-20s of net profit. So if you just had if you had a few rentals or you had a few closings, nothing big this year, and you have enough expenses to offset it, then you could just stay with the Schedule C. Okay. Now, again, you also have the intangible benefits of the reduction in the audit risk, and that's a factor also. But from a dollar and cent standpoint, strictly in, when does the cost benefit of the cost of setting it up and maintaining it versus the actual tax savings is roughly in the mid-20s. Okay, I've heard people come to me and say, "Oh, my accountant or someone said I need to make $100,000 a year to set up, otherwise it doesn't pay," or 75,000. No, not at all. Because you'll definitely have some savings, above, anywhere above 25,000, plus the intangible benefits of reducing your audit risk. And then from there, you're in the business to build it, to expand, to grow, and having the right foundation when you start. I'm not saying the moment you become a realtor, go and set up a PA. I'd rather you spend your money on marketing and developing your business and start producing and making some money first. But pretty, once you get to that point, I would say, have the right foundation set up and have the right business structure set up from there. The other thing I hear a lot is, well, I'm going to set up a corporation because now I can write off a lot of stuff. Okay, that's not true either, because you could write off the same items. Okay, the same they're called ordinary and necessary business expenses. In your case, you have the photography, you have your association fees, you have your open house fees. If you have a mentor, of course, the marketing, insurances, all that, and it's the same expenses whether you operate on a Schedule C, okay, sole proprietor, or whether you're a partnership LLC, or whether you're a PA. It doesn't change what you're allowed to expense. All it does is changes the way it's reported and the way it's taxed. Okay, so you can't just run and expense everything just because you have a corporation. It still has to be related to your business. It's got to be a valid business expense to expense it, and that's something I see a lot also. So I just want to bring that up because that's a point that is very important. So that's it as far as the entity selection and a very high level, kind of overview of the various types of entities you're going to encounter and hear about and do. I also set up corporations, for clients, so I can help you with that if you need it. It may have sounded complicated when I started talking about payroll. They're all quarterly reports that need to be filed. from the state and the federal. And at the end of the year, of course, you need to file for a W-2 and W-3. I can take care of that, or the CPA can take care of that for you. It's well worth, and that's why I said the break-even point. What I said about break-even point is the amount of savings after the maintenance or the cost of maintaining the company, which also includes potential accounting fees and tax fees related to the entity. So, so with all that said, I would recommend seeking professional advice and guidance in doing that, because down the road it will benefit you and it will save you more than the headache of not doing it right and having the right deductions. And it's not just I see myself not just from a compliance standpoint and doing, banging numbers in a computer, but being there for my clients as an advisory and consulting standpoint, to help you help understand all these things and help you with deductions and help you on advisory standpoint, not just the actual compliance and the nut and bolts mechanics of doing a tax return. That's where my value really is. Now that's that part. Now getting to a couple other areas for realtors that I see a lot is estimated payments. When you're a W-2 employee, you have, I touched upon the Social Security, Medicare that's withheld, but you also have federal taxes withheld. And presumably the amount that's being withheld in your W-2 should be equal to just about what you owe at the end of the year. And it should be almost a break even, plus or minus a little bit. When you are in business or self-employed, you don't have that what's called withholding. So what you need to do is pay estimated payments on a quarterly basis. And a lot of clients, a lot of people I speak to, they set up a separate bank account and they put 20% or 25% there for taxes. And that's good. At least you have it set aside. I can't, think about how many clients that, or, potential clients that I've worked, people have reached out to me that, things happen, unexpected expenses come up during the year. You had a good year, but now you don't have the money to pay your tax. And now it becomes a stressful situation, which again can be avoided by planning ahead of time. And not just stressful, but now you have to look about possibly borrowing money or having a payment plan with the IRS. Now you're talking penalties and interest. So the idea is to minimize your tax as much as you can, not pay additional in payment in interest and penalties. Okay. I just see a question on the board about home office expenses. The way that works with home office expenses is it's called the home office. That's used when you're a sole proprietor, when you're Schedule C. If you're a corporation, you can't take a home office deduction. But there are other ways around it where you could pay for some of the expenses through the corporate account based on a percentage basis. So you're able to do it in kind of like a backdoor way of doing it, but you can take an actual home office deduction on your personal tax return. It's done a little differently. Okay. Let's see, commission. Yeah, I see that a lot too. That a lot of realtors, they on the listing, if they have a listing property, they may put some money in there to get it ready for sale. You could show that as an expense also as a deduction. Yeah, I see that. That's all the time. I see that all the time. So estimated payments is important. The other thing that Chris is gonna touch on, because my job is to help you put more of your hard-earned money in your pocket and keep it. Chris will then help you in how to allocate, those funds the best way to make your money work for you. And that's when we'll get into retirement planning and pension planning. Depending on your income level, if you do some pension planning, not only will it reduce your taxes right now, but it'll also, help you, provide for your future, for your retirement. So Chris, I'm just going to touch on that, but Chris is going to talk about that in more detail. Now, we've been hearing about this new legislation, Build Back Better, without getting political or anything. There's a lot in there that is not good, and that is going to affect us negatively if it's passed. It looks like they're having a lot of trouble in getting it done now. So I don't know if it's even going to be passed before Christmas or even before the year. Something will get passed, and I can tell you that in all likelihood, taxes will be going up, not down, under the current administration. So count on that in one way or another. The top rate it looks like and this is something that's probably going to be passed. It's going to go up, and right now the top rate is 35%. it's going to go up to 39.6% for those making over 400,000. One of the things they're looking at also, which is actually a benefit, and this could actually benefit some of your clients, is you've heard about the SALT cap. What that is they cap the amount of real estate taxes that's deductible on your Schedule A if you're itemized. Right now it's capped at 10,000, and they're proposing to raise that to 80,000 from years 21 to 30, and then going back to 10 in 2031. So that's something, if you have clients that are looking to buy some higher end homes, more expensive homes, they would be able to, if that passes, they'll be able to deduct more of their housing costs on their tax return. You could use that as a benefit to purchasing the home. Another thing is during the Obama years, they instituted a tax called net investment income tax. What that is 3.8% of generally passive income, interest, dividends. If you're over 500,000 joint or 400,000 for everybody else. But now what they're doing is they're going to open that up to every types of income. So if you're above the income threshold, not just the passive income, interest and dividends, but all your income is going to be subject to this extra 3.8%. And that can be substantial. You know, if you run a business and have a high income, that's another almost 4% tax that's being added on. The child credit, you've all heard about that. Some of you may have received some advance payments during the year. That was raised from $2,000 to $3,000. For under 6, it's $3,600. That's actually going to be extended to 2022 as well, if it passes. Now, another big one is Roth rollovers. I don't know if anybody knows what a Roth IRA is. Basically, what it is you're contributing with after-tax dollars, so you're not getting the tax deduction immediately. But what's happening is eventually it all builds up tax-free, including your income generated from your contributions, and down the road you don't have to take any out, and when you do take it out, none of it's taxable. One technique is rolling over existing IRAs to a Roth IRA over a period of time, so it becomes after tax dollars down the road. They're eliminating that as of the end of this year. Also, one technique for high income taxpayers is called a backdoor Roth IRA conversion, where if there's income limitations to do a Roth conversion rollover, and what they're doing away with that. What it used to be is you could take a non-deductible IRA, and then once that's done, then do a Roth conversion from there. It's called a backdoor Roth IRA conversion. So if anybody are aware of that or falls into the income category to take advantage of that, that needs to be done by December 31st of this year, or you lose it forever. Well, I don't say forever, but during this administration. Let's see, another big one, and this I'm not going to have time to really get into a lot of detail. Actually, before I do that, let me just talk about meals. Part of the tax reform of 2017-18 initially did away with meals and entertainment. Then it came back and it added meals. You can deduct meals at 50%, but no entertainment. For 2021, you're able to deduct 100% of your meals. Okay, so for this past year, if you took any clients out for dinner or lunch or whatever, you could write that off. If you took a client to a Dolphin game or a Heat game, and you can't write off the cost of the tickets, but you can write off the $20 can of beer and the $20 hot dog. So that part you can write off. And that is going to extend into 2022 as well. Let's see what else. So the other thing I started saying is it's called ERC, Employee Retention Credit. If you already have a PA, you're paying yourself salary, there's a credit where you can get up to, for 2020, it was $5,000 for employee per quarter, which would be yourself. And then for 2021, it jumps up to $7,000 per employee per quarter. There's certain parameters to qualify for it. Your income needs to have dropped by a certain percentage based on the 2019 quarter over quarter. Basically, it's a COVID thing. If you got hit by COVID and your income dropped, then might be able to get back some money on your payroll tax that you paid on your form 941. And to do that, you do an amended 941. So that's something that's often very, very overlooked. And it could be a substantial amount of a tax coming back to you if you qualify for it, and depending on the amount of payroll that you had. So that's something to keep in mind, and speak to your accountant on that, or I'd be happy to reach out to me on that as well if you fall into that. So that's what I have. I mean, I could probably talk for hours, but Chris needs to get in there too, and he has a lot of real good, important stuff. I don't know if you want to do a question and answer at the end for both of us, or how do you want to do it, Kevin?
Yeah, let's just go ahead and do that at the end. I think that's a
Okay,
good call.
good.
Thank you.
All righty. Well, thank you, Don. I want to appreciate everyone for being on this call. Kevin, thank you for putting this stuff on. I know last year, or not last year, I'm sorry, 6 months ago when we did this, it was a pretty good turnout, and we got great information. I want to ask though, I see that we're at about 11:41. How much time do I have?
Chris, take all the time you need, man. We're not seeing any drop off at all. So the people are dialed in.
All righty, cool. Cool. Well, I still want to make sure everyone can get to lunch at some point, so it won't be that long, but at least we'll touch on a couple things. But before I get started, I'm going to share my screen and tell a little bit about myself, just so you have a general idea of who's talking and how this presentation is going to go. But just to kind of recap who I am, is I'm a certified financial planner, which is just the highest designation we get within the financial planning arena. I'm also a retirement income certified professional and a CHFC, which are just specialties within that area. That's all my contact info. You guys will get this when this presentation is done. So I'm not going to touch on too much of it for the concept of time. The things we will touch on today is part of your financial plan and the different puzzle pieces of it. You guys are doing a great job in selling real estate. Hell, I can't find any inventory on anything I want to buy. So you guys are doing an amazing job on it. But there's a second part of your business, like Don was saying, and it really fits into these 6 key different areas: your financial positioning, your risk management, your wealth accumulation, tax management. Obviously, we went over that for the last half an hour. Retirement planning and estate planning, which we touched on some of that estate planning, or Don touched on some of that estate planning. Basically, your financial position is a snapshot of what your finances look like now. So you could compare it to what you are every single year, or what you were every previous year. Are you becoming more wealthy? Is your income going out? Are your expenses in control? Is your debt in control? That kind of stuff. Risk management. What are you doing on the finance side to make sure your risks are mitigated? So for each one of you, you all have different risks. And it could be a health risk to make sure you have health insurance. It could be inconsistency of income, as most realtors have, depending on when they're selling and when they're hot during the year. Do we have emergency accounts set up? Wealth accumulation. Right? Are we becoming more wealthy, and which ways are we? Are we buying more property to have it rented out? Are we saving in things like the stock market or other passive-based investments? Also, what is our debt mitigation strategy? Are we applying for refinancing to lower that debt? Tax management, obviously, we just spoke on that time. Retirement planning, which we're going to spend the bulk time here. All right, so when you started your career, there's at some point you wanted to make sure that ended. Now is your retirement account. There's going to be some time in your life where you're tired of paying for assets and you want those assets to pay for you. And that's going to be retirement planning, we're going to spend most of our time on. And then estate planning. Estate planning is all the legal techniques you need to protect yourself. Don spent a lot of time on corporate structures, C Corps, S Corps, all that, PAs, all that kind of stuff. But also trusts, living wills, last wills, things of that nature. So when you look at your financial plan and you look at your business, you're going to have those 6 key different areas outside of actually the money-making stuff. The money-making stuff obviously is selling real estate. But what I want to spend most of my time on, the short time that I have, on that last, or that second to last subject, that retirement planning. So retirement planning is all about, like I said, buying assets today so tomorrow they could pay for us and pay for our living. And we could do this in many different strategies. We're not going to talk about some of the ones that are common to you guys, like rental properties. I think you guys got a good handle of that. But we'll talk about other things, like terms like 401ks, IRAs, stock market investments, things of that nature. So to start it off, let's talk a little bit about 401ks. Now, I don't know how many of you have a 401k or not, or an IRA, but basically these are accounts designed and set up by IRS to get us to retirement. They all have different rules. Now, Don was talking about corporate structure. I like every single one of my independent contractors or realtors to have some kind of corporate structure. The biggest reason I like that is so we could set up those 401ks. I know you may be working by yourself, but there is a thing called a solo 401k. And when you think about a solo 401k, it's no different than a 401k that you would have if you worked for a Fortune 500 company. The better advantage is you have more control over it. But let's talk a little bit about that. Let's say we're doing very well. Our business is growing. We're running into issues like paying Uncle Sam too much. We're also under diversified because everything we're making is based on what real estate is doing. Well, maybe looking into a 401k might be important to you guys. Every dollar you put into a 401k is tax deductible, meaning you don't have to share that with IRS at that time. Every growth or every dollar that grows at is also tax deferred, meaning again, every dollar that makes, you're not going to be sharing with IRS at that time or Uncle Sam at that time. You will when you get to retirement, but you could have had decades without having to pay IRS where you're letting this grow. And like Don was saying, with tax rates almost up to 40% again, there's a big value add to have money growing tax deferral. But let's talk about some of those limits. So some of those limits, which are changing for next year, but we'll talk about this year. If you're under 50, is $19,500 of employee contributions, plus almost another $30,000+ for employer contributions. Now, if you mind me, I said those two different things. But if you do own your own business, who's the employer and who's the employee? Well, the answer is you are both. So you have an advantage of being able to give almost $60,000 on tax deferrals without paying IRS and allowing it to grow for you. So who would like to save some money on taxes and save for retirement is a perfect example. Right? All the other ways to save on taxes, you actually have to give that money to someone else. Right? We talk about expenses. I may be able to expense a meal or a home office or the other things Don was talking about, but I still had to spend that money, meaning that money still left my pocket and went to someone else. With the retirement account, that money's not leaving your pocket. You're just moving it into a pocket that the IRS is not going to look at. So it's able to grow there. Now, when you set up this 401k or IRA, the main thing you're going to want to invest in is going to probably be the stock market or bond market or something of that nature. I say probably because you're probably not going to want to put it into real estate, even though you can, because that's your majority of your business. And one of the biggest things you want to think about when it comes to investing is diversification. So diversification is the only proven method to lower your risk and keep your returns the same, if not greater. So if our primary business is involved around real estate, we're probably not going to want real estate in our retirement accounts. It's not saying real estate's not a great way to make a lot of money, but let's not put all our eggs in one basket. Let's actually have that diversification. So if we set up this 401k and we decide, okay, I want to invest it in things that are outside what I normally do, how do we invest that? Do we buy things like mutual funds? Do we buy things like ETFs, individual stocks, Bitcoin, bonds, muni funds, and the list goes on and on and on with any and every single kind of investment you could think of. And I'll be honest with you, because there's so many options, it gets a little cumbersome. And it's something we don't really want to deal with because there's too much to know. And let's be honest, when you start learning it, there's always going to be more to know. So let's break down some of the most common ones and give you some aha moments. So if you talk to your friends who are involved in investing, they think you know a lot more than you might know. So one of the most common investments for retirement accounts is a mutual fund. Now, I'm assuming everybody here has heard of a mutual fund, right? Cool. If you haven't heard of a mutual fund, it's just basically a basket with different investments in it. And these investments could be anything. But you would know exactly what each mutual fund invests in just by reading the title of that. So if you ever want to feel like you know a little bit more about investing, or you want to understand a little bit more about your mutual funds, look at the title. They're going to tell you three main things. First thing they're going to tell you is which company is managing that mutual fund. It's usually the first series of letters or words. So if you look at your mutual fund and you see it says Fidelity Large Cap Growth, well, Fidelity is the one that's in charge of that mutual fund, or Franklin Templeton, or BlackRock, or whatever that name is up front, is going to be the one who's in charge of it. Their team making those decisions of which investments go in that bucket and which investments should we pull out of that bucket. After their name is going to be how and what they're investing in. In my example, it was a Fidelity large cap growth, meaning they're buying large companies that have a growth focus. So you know right away that's what they're going to buy. You're not going to see that. You're not going to see inside that bucket a utilities company because it wouldn't be considered growth, or you wouldn't see a small company that just started making money, or basically like that. You're only going to see very, very large companies of a $2+ billion market cap in that scenario. That also, and then the third part of that is those letters you see at the back. So whenever you look at a mutual fund, you're going to see letters like A, B, R, Z, I. You're going to see these letters. And what these tell you is actually how that fund cost structure works. So mind you, the more cost you have, the harder it is to perform for you. If you have a fund making 5% and the cost is 1%, well, you're going to make 4%. You're going to net 4, obviously. That doesn't mean low cost is always better. It just means you have to play the field of, is the cost worth the performance? And that last letter is going to tell you what that cost is, or when is that cost given to you. And we're not going to get into too much detail about each and every single letter because there's a bunch of them. But if you do have any questions about which fund you should have, let me know. I tell a lot of our clients, and I usually give it out to them, a sheet that says which letter means what thing. So you could reference that sheet when you're picking out your own funds for your retirement account. But we know that. We know we could put money into a 401k tax deductible. We know we're going to buy maybe mutual funds with it in this example. We also know it's going to grow tax deferred. At some point, we're going to want to take that money out. Now, I know we have too many people on this call, which is amazing to be able to answer some of these questions, so I'm going to go ahead and answer for you actually, but there are limits to when we could take money out of our 401k. And the main one is an age limitation. The IRS gave you these benefits. They allowed you to have tax deductions. They allowed you to have tax defer growth. And they're going to ask for one main thing, and that's that you don't touch this money before you reach the age of 59 and a half. Now, a lot of people ask me, why a half? And the answer is, I have no idea. That's what they decided. But 59 and a half is the day you could start touching this money. One disclosure I want to say is there's a lot of exceptions to a lot of rules. And there's too many people on this call to talk about exceptions that may apply to each and every one of you. We're going to talk general. So 59 and a half. If you take money before 59 and a half, you're going to be taxed at whatever your tax rate is that year, plus you'll have a 10% penalty. And that penalty is not from me. That penalty is not from where you're investing. That penalty is from IRS. Again, there are some exceptions, but we're not going to talk about those exceptions here. There also rule is you have to start taking that money by 72. So when you get to retirement and you have this money grown for as much as you need, make sure you think of that. So what I definitely want to talk about also is the number one question I get about retirement accounts. How much do I need to have? Now that answer is unique to everybody, but I'm going to give you a little scenario to help you out with that. So before I get into that, I want to tell you a little study because some of you may feel like you're behind when it comes to retirement accounts. 2017, JP Morgan did a study. They asked all their clients from the age of 50 to the age of 65, how much they felt they needed in their retirement account. Now, regardless of what that number is, some of you may say it's $1 million, some may say 10 million, some may say 100,000, some may say anything. And I'm going to want you guys to think about how much money do you think you need in your retirement account? Now that you have that answer, what they came to is about 65% of the population said they need at least $500,000 in their retirement accounts. Again, regardless of what your answer is, that's what at least 65% of the population thought. But out of those same people studied, the average retirement account was only about $140,000. So you got to think the average person feels they need 3 times the amount of money that they have. And I bring that up to let you know that you're not alone if you feel like you're a little behind. There's ways to get us back up to what we need. And heck, these individuals may not have known $500,000 was the amount they did need. So how do we find out how much we need individually? Yes, we have so much technology that will help us. And if anyone wants to know what their number is exactly, let us know, send us an email. We'll send you a report that will help you out figuring that out. But let's just use this rule of thumb. The rule of thumb is this: whatever the amount of money you need to live on today, you're going to add inflation to that, which we could talk about in a second, because inflation's kind of that thing that is biting everyone on the butt today. You're going to add inflation to that, and you're going to times whatever number that is by 15. So let's use an example. Let's say I'm 50 years old right now, and I make 100 grand, or I spend 100 grand a year. And I plan to retire, let's say, in 20 years. And let's just say inflation is 3%, which is the going rate of inflation now. But what that means is that 100,000 times 3% for 20 years means I'm planning to spend about $200,000 in 20 years, and I'm going to get the same thing I'm getting today. So I'm going to explain that again. If I add inflation over a 20-year time period at 3%, the money I'm spending today is going to double for the same amount of goods. So in my case scenario, if I'm retiring in 70 and I want to spend $200,000 a year, keep my same dollar amount or same purchasing power today, I'm going to spend that, and then I'm going to need to times that by 15, which would be about $3 million. So in my scenario, I needed $3 million to get there. I'm not saying that's what everyone's is, but that's a rule of thumb to help us figure out how much money we need for retirement accounts. So I do see a question here about something we did talk about mutual funds, no load mutual funds. So the term load is referencing to how they're being charged. Those letters I was talking about at the end. Now, no load basically means that you're not being charged upfront or a back end large amount. If you think of a mutual fund charge, think of it as driving down the highway. Some have tolls when you get on, some have tolls when you get off, some have tolls depending on how far you go on that road. Well, no load means there's no charge to get on or off that road. There's a charge while you're on that road. Just to sum it up for you. It's a numbers thing. That being said, we're pushing against this 12 o'clock. I try to make this short, sweet, and simple. Everything I gave you is super generic, and nothing I gave you may be unique to you. The uniqueness to you comes on if you do sit down with Don or you do sit down with me, trying to figure out what your financial position should be. Now, all this stuff is free for you guys because we are part of the association to figure out what that retirement number is. Now, this was a short presentation, but I want to make sure that every time we do one of these presentations, we get a little better. So I have a little incentive for everybody. I'm going to put up on my screen a QR code. It's a survey about how well we've done for you. Out of that survey, we're going to pick 4 names, and those 4 names are going to get a $25 gift card for Amazon. I know everyone's using Amazon here. So I'm going to put that screen up and I'll answer some questions while it's up here. I also know everybody knows how to use a QR code. If you don't know how to use a QR code, you haven't eaten in the last year and a half, because they're for every single menu. So let's look at some of these questions. Cool. About IRAs and Roths. Cool. So the first question is, if I have a traditional IRA and also a Roth IRA, do I have to put everything into the Roth before December 31st? And that's a unique question based on some of the rules that may change, but the answer, how it's written out, is no. You actually have until you file your taxes or April 15th to be able to put money into those accounts for the previous year, and they'll still get credit for that. Now, what are those limitations? You could give, if you're under 50, up to $6,000 to your IRAs or Roth. If you're over 50, you could give 7. Again, that will change for 2022, but for 2021, that's how much you can give. Now, I am going to touch a little bit on a Roth. Roth is a little different than how I explain the traditional 401ks and IRAs. But the only difference is how it's taxed. In a Roth, you do not get a tax deduction up front, but that money does grow tax-free. And IRS says, because we didn't let you get a tax deduction up front, we're not going to charge you taxes in the future. That is how the rule is set up now. The rule may change in the future. Remember, we also didn't used to tax everyone on Social Security, but since 1986, we changed that rules. Oh, we got another question about life insurance contracts. So life insurance contracts, just like every single contract you've ever set up for anyone who bought a piece of property, is unique to that contract, but they all wrap around one unique thing. And that's, like I said, that's like we said, life insurance, that's your life. So within life insurance contracts, you're going to see a million different ones. You'll see what they call term insurance. Term insurance is like renting a home. You get insurance or a lease today, you have a roof over your head that is protecting you and your family if God forbid something was to happen to a certain time period, 10 years, 15 years, 20 years, whatever the case might be, whatever those lease agreements were. At that time period, you could renew that lease at a different rate, or you could get out of that house, to use an example. Then you have ones that have cash value. Think of these cash value ones as ones like that that are like owning a home. You have equity in that home. Now, everything is made a little different, and that's all I'm going to really touch on that, because they have all different metrics of how that cash value builds. Some are great for some are not for others. I want you to think of life insurance as individually as home buying, right? There's not a single home that isn't right for somebody, but it may not be right for that client. That's how life insurance contracts are set up. Well, I got a question. If they have an LLC, can you contribute more than $6,000? Well, it's not so much about the LLC. That's important. You need to know. It's about the kind of, or where you're contributing that money to. If it's to an IRA, that's the rules. Unless you have what they call a SEP IRA or a simple IRA. These are two offshoots of IRAs that allow you to give more. And there's values in each one of them. That does not mean one trumps the other, just means there's values in each one of them. If you guys do have any of these particular questions like that of saying which one's best for us, on that survey sheet, there's a place where you could ask questions. Ask those questions, we'll send an email to you. If you do want to have maybe a half an hour one-on-one, because maybe your questions are unique to you and your family, or they go into more depth, there's a link on that survey to link to our calendar. Find a half an hour and we'll have questions and answers just like this. The difference in this and that one is that one will pertain exactly to you. You won't hear the word depends or general. You'll hear the words for you and unique. So that being said, I want to hand it back over to Kevin. I hope everybody got something out of this workshop. I hope we see great survey results, and be nice to me on them, I guess.
There was a few more questions for you, Chris, if you got time.
Okay. Yeah, I definitely have time. So
Somebody was talking about, wanted to know more about life insurance contracts.
Yeah, so I started touching on those life insurance contracts. Again, let me touch on that again. Life insurance contracts are as unique as any contract someone may sign. They may be all around one subject, which is life insurance, but they are unique. So there's ones that I touched on, like term insurance, which is like a lease agreement, right? You have this insurance for a certain number of time. And then there's ones that build cash value, and they means they have more bells and whistles, like if you owned a home and you built equity in there. but each and every single contract is set up unique. So in this setting, that's too generic of a question to be able to get details about that. I would recommend that person schedule a half an hour time on our calendar. We'll be able to go into detail of which 2 or 3 are advantage to that person. And yeah, that's probably how I'd recommend that one.
Very
There's
good.
a lot
And
of
I
stuff.
will, I'll send the contact info, your contact info over to everybody as well, when we send the recording of the class. So very good. Don, you still here?
Yeah, do you want me to answer some of the questions on the chat?
Please,
Go
please.
through
You
that?
had
Okay.
quite a few.
Okay, yeah, there's actually some pretty decent ones on there. Let's see, there's one, if you're a single member LLC and choose to put yourself on payroll, what would be the impact? Well, if you're a single member LLC, like I said, you're a disregarded entity and you file a Schedule C, the net profit, like I said, is subject to that 15.3% self-employment tax. So you're already paying in employment tax on it. There's absolutely no reason to set up payroll for a single member LLC. You don't need to do it, okay? So there's no reason to do that. How do you know if your PA is an S Corp? Well, it depends on how you initially set it up. If you did it yourself, if you don't recall doing a form 2553, and then at some point after that, receiving a letter from the IRS of approval as an S Corp status, then chances are you're not, okay? But if you had a company do it for you and part of the documents for doing the S Corp filing, look through your documents and you should see, again, a form 2553, and later on, you should have received a letter from the IRS. If you don't see any of those, you're probably not, but to be sure, you can call the IRS and they could tell you, based on your EIN number and the name of the company. That would probably be the best way of knowing for sure. Let's see, some other good ones here. Payroll company recommend, they're very expensive. It really depends on the company. What a lot of my clients, I actually do payroll and I do it for them, which usually comes out less than what the payroll company would charge. And when you're using someone like me as opposed to a payroll company, it's not just the mechanics of processing the payroll and doing the payroll reporting. It's also the advice part of how much payroll to do. Okay, so when I work with clients, I meet with them on a quarterly basis, and I say, okay, what are your numbers for this quarter? We look at it. Based on that, I think you should do X amount of payroll, or maybe no payroll. Maybe it's not even necessary. But that you're not going to get with a payroll company, because you're just going to tell them what the hours are, what the payment is, and they're just going to do it for you. So so that's that. Let's see here. Clarify the 50-50 payroll distribution would be okay. I use the 50-50 as a general guideline, as the starting point, okay? What you also look at is what would, let's say, an average realtor with the amount of sales make in your specific geographic area. When you get up to, the 400,000, 500,000 commission levels, you don't need to do the 50-50 because there you're looking at about 200,000 payroll. You could generally bring it down at that point. If you're looking at, 100, 200,000, then you could use that 50-50, 40-50 as a general guideline. But I would actually look at it more of the specific circumstances in each case, like what Chris says. I won't give you depends or it'll be more unique. So I also offer a free initial consultations for half hour. So feel free if anybody has any questions that doesn't get answered here. On my website, I have a link where you can schedule an appointment. Just go on there, schedule it, and we'll chat, and I'll give you whatever information you need there. Let's see, what percentage of distributions, PA. Let's say I have payroll for myself and my employees, but I want to higher than my payroll. Again, it's the same distribution. I'm going to say here, it depends. It's very subjective. It depends on your situation, but that's just a general kind of starting point, is that 50-50. Does the name have to be exactly on the driver's license? I don't believe so. That'd be more of a licensing DVPR issue. I never heard that. I don't know if when you apply for your licensing, if it has to be what your driver's license is. I'm not 100% on that. That's something you can check with the DVPR. I've already have a single member. Okay, this is a great one. Okay, now I mentioned that single member LLC, you do it yourself, you think you're all set, comes the end of the year, you meet with your tax advisor, your tax preparer, and now I have a single member LLC, you're still in a Schedule C, did absolutely nothing for you. Well, there are ways of retroactively electing a single member LLC to be an S corp. Okay, I didn't get into it during the presentation because, as you see, I already ran over. But there's a lot of other details, more details we can get into, and that's one of them. And that's a great question. So just because you didn't do it right initially, it doesn't mean you're stuck and it can't be undone and it can't be fixed. There are ways of fixing it. Okay. A lot of responsibilities associated with setting up the PA that I didn't expect. That's why it's very important to meet with an advisor up front. That way, you know exactly, and even this presentation right here, this gives you a lot of different options, a lot of what you're going to expect. But meeting with someone, like I said, I do a half-hour, free consultations, initially, and the biggest thing is knowing what your options are, what to expect. I don't like my clients having surprises, whether it's a big tax hit at the end of the year, or if they have some big changes in their lives during the year that changes their tax situation. I like things to be planned ahead and not have surprises. So meeting with someone initially, going through the options, going through what to expect, that's very important. That way you'll know what you're getting into and you make a decision whether it may not be right for you or not. Okay, but at least having the information is real important. And I highly recommend that, whether it's with me or someone else. Let's see, there's a quarterly thing that has to be done with Florida Revenue Reemployment. Yeah, like I mentioned, there's quarterly payroll reports. One is the federal, which is a Form 941. And then you also have, as an employer, in this case, you're the employer and the employee, you also have to file unemployment reports. Well, now they call it reemployment reports, which is called the Form RT6. And to do that, there's other steps that I didn't get into as far as setting up the corporation. When it gets into payroll, you have to enroll for your unemployment tax number with the state. And depending on how much payroll you're doing, there's also enrollment with the federal, it's called an EFTPS payment system on the IRS website. And that's where you make the payroll tax payments. Depending on how much payroll and how much payroll tax is involved. And I go over that and I could take care of that for clients as well. Let's see. Do you need to open a bank account in the UK? Yes. The PA is a corporation. It's a separate legal entity, and you're gonna open up a new corporate bank account in the name of your PA. All your deposits, all your revenues will go in there. All your expenses will go in there. I recommend getting a debit card, not using cash, so you don't have to chase after receipts. You just have your debit card. Everything gets your bank statement. Depending, another thing I didn't get into is the accounting part, the bookkeeping part. There's different ways of doing that to keep things easier and more efficient. And that's a whole nother discussion. I could speak an hour about that. But again, if anybody has any questions, you could reach out to me as well. But yes, you do need a separate bank account. Advisor claiming miles, but yeah, mileage, auto expenses, in a broader term, is a big expense because obviously you use your car a lot. It's different whether you're a sole proprietorship, sole proprietor on a Schedule C versus through a corporation. It changes a little bit. I don't want to get into too much detail with that, but again, reach out to me if you need more details. But yes, auto expenses are a big part of deductions for especially for a realtor or any kind of sales for that matter. Let's see, there's a $25 allowable client gift provision also allow you to gift office employees. That's interesting. Well, as far as the allowable gift, I mean, you could designate certain expenses as promotional expenses, not necessarily as a gift. Allow you to gift to office employees. Well, I mean, yeah, you could gift to employees. Now again, a gift is not a deductible expense. A gift is a gift. Okay, so it's a lot. Some of it is semantics, how you show it. If you want to give an employee, some gifts at the end of the year, you can show it as a gift. It's not really deductible. The same thing with clients. If you're using it as promotional purposes, then you show it as an advertising promotional expense. So I don't know if that answered it. Let's see. talked about the mileage. Traditional IRA. I just want to reiterate a thing also. There's a question about the IRA and the Roth IRA. That does it have to be done by December 31st? What I was talking about that is not a new contribution to the Roth IRA. I was talking about a Roth conversion where you can convert a traditional IRA to a Roth IRA. That's what's going to be changed after December 31st. And for some people, there's certain strategies that you could do on a regular basis to over time, do traditional IRA conversions to Roth. So eventually it'll all be after tax dollars, and you won't have to, have a big tax bill down the road when you take it out. So that's what that is. Let's see here. How can you change the LLC S Corp to PA S Corp? Okay, what you're going to do with that, I kind of answered the question before, but you're not going to, you can actually change an LLC as an entity to an actual S Corp. Okay, it's an entity change, but a much easier way of doing it is you're still going to be legally technically an LLC, but you're going to elect to classify it to be taxed as an S Corp. And that's by filling out a form 2553. Okay, if it's a brand new company, if we're in 2021 right now and we're doing the 2021 taxes next year, and you form the LLC this year and you haven't filed any taxes yet with it, then it's very simple. We could do it. We could either attach the necessary form to the S Corp tax return when it's filed and convert it that way, or you could do it separately during the year. If you decide, okay, it should be an S Corp, I didn't realize it. If it's an existing LLC that's been around for a few years and you already, filed it as an LLC, then you can still do the election, but you have to do it by March 31st of the current year for it to be effective, in this current year. So the same example, if you had an existing LLC and you decide, okay, I want to change it to an S Corp now, you can do retroactive to 2021, but in 2022, as long as you do it by March 15th, then it'll be effective as of January 1st, 2022 going forward. Okay, so, and that's actually a very good question. Payroll is difficult, especially that the income is not steady and varies. Yes, that's true. That's why, like I said, I will meet with my clients on a quarterly basis, and on a quarterly basis determine how much payroll is appropriate. So, and it may be a quarter, maybe you didn't have any closings, so you may not do any payroll for that quarter. So it is done on a quarterly basis to determine how much payroll. The idea is to not pay too much payroll. So you pay, more payroll tax than you need to, but pay enough in so you satisfy the IRS if you don't get audited. It's kind of that balance, and it is a subjective thing. But it's not a black and white, type tax law thing. It's a lot more subjective.
I have a question for Chris. It was sent to me privately. Chris, somebody asked, they have a real estate owned, pardon me. They say, I have a real estate owned by myself directed IRA, but I've heard the Biden administration is planning to prohibit IRAs to own real estate. Do you have any updates on that proposal?
Yeah, so there's no updates on that so far. And I don't think you really have to worry too much about that. The more worry is administrative part you're going to have if you plan to keep it at retirement. After retirement, it becomes quite difficult because real estate's not a liquid investment. So you have to still get money out of that to pay some what they call RMDs. But no, so far right now, there's no updates and no changes on that. It's a great way to have tax deferral. Just be careful because that's the first thing that's going to be looked at if they look at you when they try to audit you.
Thanks, Chris.
Kevin, I'm just going to cover a couple more because I know we're running pretty late. And then if anybody else has any questions, feel free to reach out to me. There's one that's interesting. I've heard changing a CPA for tax return will trigger an audit. Is that true? No, it's not true. The IRS doesn't care who's preparing your tax return, whether you do it yourself or you have a preparer doing it. So no, that's not true at all. Let's see here. The amended 941 form for the credit. That's something that I'm not going to cover now. It's pretty complicated. Again, reach out to me if you need more information on that. The amended 941. I think that's it. I think that pretty much should cover it. If anybody else has any questions, again, reach out to me. You just go on my website and just set up an appointment. I'll be happy to chat with you. Okay.
Very good. Don Fallenbaum, Chris Price, thank you so much for your time today. I really do appreciate it. Everybody will be sending you their contact information, a recording of this class, and any other materials that were shared here today. So we wish you the best of luck for 2022 with your retirement, your savings, and your taxes. These are the pros if you need any help, so do not hesitate to reach out to them. And we hope you can save more money next year. And so with that, if you are able to save money with this class, we hope you invest it in yourself because you are most certainly worth it. And with that, we'll send you off on your way. Everybody have a great Thursday, and we'll see you next year. I think the class series is done. Thank you for all your support, and we'll have some great programming coming back to you in 2022. Thanks, everybody. Have a great day. Take care.
Yeah, I'm on my way home, yeah. Wouldn't it be crazy? Don't you still amaze me? Wouldn't it be crazy? Don't you still amaze me? Wouldn't it be crazy? Don't you still amaze me? Wouldn't it be crazy? Don't you still amaze me? Yeah, I'm on my way home, yeah. Yeah, I'm on my way home, yeah. Wouldn't it be crazy? Don't you still amaze me? Wouldn't it be crazy? Don't you still amaze me?